Nancy Poppy is an off-time contributor and off-time panelist and moderator for us. She's been with Willis Towers Watson. She has over 25 years of experience as an insurance broker, exclusively addressing and serving the needs of super yacht owners. As North American yacht practice leader, Nancy is responsible for building the niche brand and reputation as well as developing its client base. She oversees the practice's delivery of quality yacht risk management and insurance broker expertise to super yacht owners. Let's give her your attention, and I think, are you in turn going to introduce your panel? Thank you, Nancy.
Testing, testing. Oh,
Cool.
I have a feeling I have to. Can you hear me if I do it this way?
I can hear you.
Yes? Okay, thank you. Thank you, Bob, and thanks everyone for being here. So I'm Nancy Poppy, an insurance broker with WTW. Our lights are on the wall. How exciting. And so the panel participants have so much experience that it really is an honor to be here with them. Unfortunately, Bob Peck, who was on the slide before, is unable to make it today. But I do have to ask you never to get on the same airplane together, because our industry would certainly suffer if something would happen. So Laura Sherrod, in the middle there, Director of Yacht Insurance with New Coast, Melanie Jawls, Yacht Finance Specialist with New Coast, and Mike Karcher, who has a long and storied career as an Admiralty attorney, currently with Robert Allen Law as counsel. And I have to thank the first panel today, if I think most of you are here, for really setting up exactly what we're going to talk about, which is setting expectations, managing your clients' expectations, timing, and then issues that frustrate and prevent your deal from closing. So with that, here we are again talking about insurance and finance, two of the things which hold up your deals. But these issues never seem to go away in these two areas. And they're intertwined because without insurance, you can't get financing. So we hope to give you some, as Bob said earlier, little gems of wisdom that you can take away, not only to understand the issues, but how you can perhaps prevent them from becoming items that frustrate your deal. But before we go into that, just a quick overview of the size of our industry. Melanie?
Sure. Welcome, everybody, and thank you for having us again. You're either going to love us or hate us, but we're here hopefully to focus on some of those best practices. But as Nancy said, this is a very amazing statistic. I mean, 5,396 super yachts, over 98 feet in length, operating in the world, and over 23% of that fleet owned by U.S. citizens. So, I mean, it's a very staggering statistic, how important this industry is, you know, worldwide, and particularly its impact on Florida with a multi-billion-dollar industry. And we all make our living on it, which is pretty exciting. So how do we do it better, and how can we help you better? So we've tried to address some best practices when it comes to financing. And one of the most important decisions that happens sometimes late in the game is there going to be financing? How does the customer intend to pay for the boat? And it's really important that that happens early on in the game, because is it the customer that's buying the boat? Is it a trust that's buying the boat? Is it a company that's buying the boat? Is it a company to be formed that's buying a boat? So determining the buyer pretty early on, which starts with your contract or a letter of intent, what's going on that contract, you know, John Smith and/or signs. You know, it's pretty important to start identifying that from early on in the transaction. If it's a person, is it the person? Is it the person and his wife? I can't tell you how many times we've gotten to the point where we're ready to close, and the bill of sale comes over in two names and the loan's in one name. Well, that doesn't happen. That can't happen. The bank's not going to allow that to happen. So then we got to go back and resubmit and add the wife, or change the bill of sale, take the wife off. Her feelings gets hurt. You know, it's just clarity and best practice. So who's the buyer? And then taking that one step further, is the buyer a U.S. citizen? Is it a foreign national? Is it a non-U.S. citizen? Is it a U.S. entity? Is it a foreign entity? Are their paperwork, is it ready? Have they worked with an attorney who did the paperwork? I mean, again, we get this paperwork and sometimes it's completely unacceptable to the bank, and back to the drawing board, and we start eating up that valuable time clock on your contract. So again, step one, and you all know this, but it's just great best practices. Then step two, whoever the person is that's selling the boat, that is just as important as who's buying the boat. You know, we had a closing going on last week that dragged on an extra week because the seller's paperwork was not in good standing with the Cayman Islands, and he'd nominated a new director, and I mean, never told anybody, the paperwork wasn't notarized. So again, in certain times of the year, I mean, that can be a disaster, right? The Cayman Islands closed, the Marshall Islands closed, we're trying to get deals closed, we're running into the end of the year, the clock is ticking. You already know how that works out. So who is selling the boat, and is their paperwork ready to go? The next thing we consider in terms of financing is, what's the client's use of the boat? Is it going to be personal pleasure? Is it recreational? Are they going to charter it? Is it going into a managed fleet? Believe it or not, all of that determines the lender that we identify to be our partner in the transaction. And if we get it wrong and we have them with a bank that doesn't allow the usage that the client wants, then again, you know, we have to start all over again, and that's your time. Where is the closing taking place? Where's the boat? You know, is it in U.S. waters? Is it at the factory? Is it outside U.S.? What kind of due diligence do we need to do? Certain banks allow that. Certain banks require that the boat be in U.S. waters at the time of closing. So again, just understanding where that intended delivery is taking place. And then the structure of the purchase. You know, is it just the boat? All of a sudden we're at the closing and we find out there's a tender. You know, it's not on the insurance, which Laura will talk about, but, you know, we don't have any paperwork on it. It's not part of the corporation. I mean, all these things happen, right? We know they do. And so we want to make sure that we've identified toys, tenders, completeness. And then setting, and that was touched on this morning, which was great, was the survey. You know, because are there things that come up in the survey that either prevent the deal from moving forward or slow the deal down? Things that are that impact the insurance, and things that the bank may say, oh no, you know, we're not closing until this is fixed. So those are really some key points, best practices.
Well, thank you. And now let's move on to the other exciting topic, insurance. Sorry.
all right, hold on.
Before we go there, you kind of just talked about, but an overview of the health of the finance market.
Well, you know, everyone says, how long does this take? Well, honestly, that depends on the buyer. You know, we've had contracts that are written with 30-day closing windows, which should be more than adequate, but if the client doesn't produce the information on the front end for days or weeks, then the whole process gets backed up. So we try to put some timetable parameters on this to say that 21 to 30 days on a contract should be reasonable, but sometimes it's not. Collecting the financials, that should be a couple of the days. If your client's really interested and invested, we should have the financials right away. It takes us maybe a day or two to review them, target the lender, put a complete package together, send it to the lender. Depending upon the time of year, that can take 1 or 2 days, or it could take a couple of weeks. If everybody's out of the office at a boat show or playing golf or whatever they're doing, then we have no control once it gets to the bank how quickly they turn it. But the general expectation is it gets turned within a week. Then we come back, we have to clear the survey, a couple of days for the survey. We have to clear the insurance policy, a couple of days for the insurance policy. And then depending upon the time of year and how busy everybody is and how quickly we get the documents that we need from both sides to pull the closing together, 3 to 7 days to close. I mean, those are reasonable expectations. Sometimes we get contracts that have like an acceptance date of the 1st and a closing date of the 5th. And we're like, well, what's happening here? How is this possible? But, you know, it's, again, you know, when you write that contract and you set those timetables, those reasonable expectations with the customer, that it's just good, clean communication and transparency, and we all want to be one thing. We want time not to kill our deals.
And I noticed that it says 21-day absolute minimum for finance on simple deals. And this morning, David talked about, you know, their role of the attorney in managing expectations and how they talk about 2, 3, 4 weeks before acceptance, and then a minimum 1 to 2 weeks after acceptance to close. And so that 21-day on top of 1 to 2 weeks obviously doesn't match. And I think that's when we get the calls most often, is after acceptance, not when the kind of dream is born and the survey's engaged. And I'm going off piste here, but we will tell you that the time to pick up the phone to call insurance and finance is actually when the survey is being done, because that gives lead time. And if the deal falls through, so be it. So
True.
now we're going to talk about
There you
insurance
go.
market.
Thank
Laura.
Well, it's fun to sit here and talk about finance and insurance together, because typically you hear about finance and then you hear separately about insurance. But there's some crossover, and that's why I have a picture of dear Charlie Munger. Charlie Munger was Berkshire Hathaway. He was Warren Buffett's mentor, actually, and he just passed away. But he had no filter. He would just say things, and he was really kind of funny. So he had this comment to say about insurance. And Berkshire Hathaway is a pretty big insurer. They own Geico. They're in the insurance business, to say the least. He said, "It's not a great business, property and casualty insurance. It's a tough game. There are too many temptations to be stupid. It's a lot like banking." And so I laughed at that, because yacht insurance has been really stupid for a number of years. And so I wanted to talk about the overview of the insurance market, because when he's talking about being stupid, he's talking about not looking at the long term, not realizing that you have to be financially sound in order to make good decisions that will let you stay in the insurance business. So they've been doing some correcting of past mistakes in the yacht insurance world. Restrictions on what they'll write, exclusions on things that used to be covered, raising rates, and just flat out not quoting at all. So I wanted to kind of give one of the basis of insurance. Insurance is to bear the burden of the few by the many. I'll say it again. The burdens of the few by the many. That means don't have a claim. In other words, you have to have a pool of risk. You have to have enough people in the pool in order to cover the few that have the losses. It works great with automobiles, because there's 290 million automobiles and not everybody has claims. But there's only 8,000 really yachts in the world, and the pool is very, very small. So when we have these losses, and we have losses, you see them around the world, they affect our ability to find good markets, because the markets say, I think I'll go do something else where I can actually make some money. So that's really why we have a bit of a crisis here in certain segments of the marketplace. And one particular market that Nancy and I were talking about, that I kind of specialize in, is the 10 million and under. Nancy's monster boats, Mine are just kind of normal people that like boats. So
Normal $5 million boats.
yeah, normal
$5 million boats.
So some of these things, as far as some of the limitations and restrictions that we're seeing on boats in the United States, have to do with some of these things. Absentee owner. An absentee owner is defined by the insurance company as anybody who has two homes. Well, that's kind of silly, right? But they are actually, in the US carriers, considered absentees if they have two houses, because guess what? They're not going to spend August in Miami. They're going to spend August in North Carolina. So absentee owners, their biggest concern there is windstorm. Reinsurers right now are what I call long-tailed cat in a room full of rocking chairs. I mean, they're just really nervous about wind. They're anxious. And so that's issue number one. Then the second is the first-timers. We saw this after COVID. A lot of first-timers getting into the marketplace. Love it, that all these new people into boating. But of course they think, well, I should be able to run this $2 million boat. And the problem is they really shouldn't. And so we have had, the claims history is there. First timers, they don't do the maintenance right, or they do something stupid, and then we have losses from them. So first timers is an issue. Older boats. So older boats, the problem being that, again, maintenance may not have been up to standard, and the vessel may end up having a loss that probably should have been a maintenance thing, and they just didn't repair it, and something happens. And so that becomes an issue. And older, is a relative term. Some carriers it's 10 years, some carriers it's 20 years, some it's even, they'll do older, but it does also depend on the pedigree of the boat. And then lastly, just on a price experiential basis, a full-time captain is a better risk, according to insurers, than a part-time captain. And full-time means no other job. That person is dedicated to that boat on a full-time basis. With that, we have multiple carriers who say, yes, we're interested. With a part-time captain, or then you may end up with maybe one carrier and maybe paying 4 times as much as you would for a full-time captain. So what I would say with these notes is, and Nancy, maybe hit the next one here, I think. Oh, no, we're not there yet. Hold on, that's one more. But there are solutions. It's just that there has to be a lot of conversation. You can't just assume that you're going to find a good option for your client. And that's also why we bring up the next slide, which is towed tenders. You guys have a lot of control over your clients. You have great relationships with them. You want them to have a great experience in boating. You want them to buy 1 boat, you want them to buy 10 boats, right? Well, make sure that they buy the right tender, because if you get somebody with a 100-foot boat and they buy a 45-foot tow behind tender, it's very unlikely we're going to get it insured. Honestly, it's going to be a problem. So, I mean, Nancy, you deal with this every day as well. If you have a big tow behind tender, which I know every charter boat in the Southeast wants to have, there's a lot of risk involved. We see the claims all the time, and I could give experiential claims on that, but Nancy, do you have anything else you want to add to the towed tender?
The towed tender
saga?
Yes. Well, also, preparation and managing your client's expectation is key to this whole thing, the theme throughout. And so oh, by the way, we have a towed tender the day before closing usually doesn't go over too well with insurers. And also managing your client's expectations about what is a reasonable size to tow, what they can get insured, and if you don't know, ask one of us or your favorite insurance broker. Towed tenders are lost a lot. They sink, they swamp, they go missing, they turn up, and then salvors claim them, and then the salvage process is expensive and long, and meanwhile the owner just wants another tender. So there's a lot that goes into it, a lot more I think that goes into it to be considered to make it a safe and enjoyable and insurable experience with towed tenders.
Yes. So, yeah, I mean, nobody wants to have a claim. I know that, because even if it's a great experience, it still sucks, okay? There's a 50% deductible often on these towed tenders. It's not great. And, at the best, we can get a maybe 10% deductible for towed tenders, which could still be a lot of money.
Yeah, when these tenders are $1 million, we were talking about it earlier, it's a line item on some policies. My $1 million 4-engine, HCB, whatever the builder is, that's an expensive proposition. So, and it's probably the part of it that's going to be damaged or lost. So moving right along into some of the challenges, there's insurance for breach of warranty and mortgagee's interest. So that's really a lender requirement, but I thought, Laura, can you explain what the coverage is, and then Melanie perhaps tell us when it's required?
Sure. So this is one of those wonderful clauses that actually says what it is, which a lot of insurance doesn't. So breach of warranty. Well, policies have warranties on them. One is navigation warranty. One is seaworthiness warranty. One is, maybe a named operator warranty. So these are restrictions on the policy that say you must or you must not do these things. And to breach a warranty means you've done something that has voided the policy. Well, the bank is innocent in that. So the bank is allowed to remain insured or get paid if the client does something that breaches a warranty on the policy. So, for example, your client goes to Cuba, runs aground or something, and the boat's there forever. And the bank would still get their mortgage paid. So it's a nice policy. I recommend it, actually. The difference between breach of warranty and mortgagee's interest is the mortgagee's interest is just in the name of the bank, as opposed to it being an endorsement. Breach of warranty is an endorsement onto the yacht policy. So two things that I think is required, and you've told me this, basically for any vessel that does charter.
Correct.
Or any vessel that has a loan more than $750 or $1 million?
It depends on the bank. So some banks are at 750, some banks are at $1 million. In my mind, why wouldn't the bank want this, regardless of the size of the loan? But if the client's going to